All right, good morning, everybody. We've got a seminar topic today is estate planning and investment opportunities created by the COVID-19 pandemic. So it's a very relevant topic on what's happening in the world as we speak. So often we're so focused on building assets, we overlook how to protect those and smartly transfer those assets we work so hard to build. So today we've assembled a great panelists to discuss this topic, and we have Don Linzer and Derek Eichelberger from Schneider Downs to discuss the transfer strategies. Unfortunately, we'll see if Derek decides or is able to get back on. He's having some internet issues. I think a lot of us have experienced that through the last 3-4 months with everything going on with COVID. And we also have Jimmy Milliron from Miami Life to discuss life insurance, how that could come into play with the strategies around estate planning. We're going to take about 50 minutes with the presentation, leave time for any questions at the end. However, we highly encourage questions throughout the seminar. If you're new to Zoom, there is a chat function that we ask you to use when asking questions. Again, you can ask throughout the seminar. We can wait to the end. This is designed for you, so whatever you're most comfortable with. We will stop if we have a relevant question at the time throughout the seminar and answer that. And with that said, again, welcome everybody. Don, you have the floor.
Thank you very much. Glad to be here today, and we're going to be talking about how COVID impacts your investing and your estate planning. It's a very interesting topic. What happened in March was unprecedented when the Fed basically made money free. So that's going to be one of the overall topics that we discuss here, how the low interest rate environment in conjunction with the election that's coming up in less than 100 days impacts your wealth transfer and your estate planning opportunities. Next slide, please. Next slide. Okay, so what happened in March? What happened in March is that interest rates went very low, and the Dow Jones Industrial Average is closing every day at a new high. This slide here was done in April when lockdown was crazy. The market, the last time I did this webinar was 24,331. When I checked yesterday, it was 27,812. People were asking me in conjunction with our wealth management practice, how can the market be so high when Main Street has such issues? And it's pretty simple. The Fed is basically allowing banks in large financial institutions to borrow at almost zero interest rate. That money is feeding the stock market and creating what's probably a bubble, but this low interest rate will be with us for a while. It is creating opportunities that you need to take advantage of. Next slide, please. April 1, the effective federal funds rate was 6 basis points. It's been low for a long time, but in February of 2020, before the pandemic, it was 1.58%. So one of the things we're going to talk about is how you can utilize these low interest rates in your insurance planning, as well as your estate planning and your succession planning. Many of the people on the call today have closely held businesses with family in the business, children, and this is an opportunity to reevaluate your estate planning and your succession planning. If you've not done succession planning, this is a great time to do it because of the availability of a very high exemption equivalent rate with the IRS and low interest rates. We're going to get into that in a lot of detail today during the webinar. Next slide, please. So what this busy slide shows is the tremendous amount of volatility in the market is represented by the so-called VIX index. In March, it hit 80. It's down a bit, but it's still at very high levels. It was 40 in the 40s yesterday. When the market was calm in 19 and 20, it went between 20, about 15 and 20, off and on. And you can see to the right what parts of the market have done very poorly. Energy's done the worst. Nobody's driving. I spend a lot of time in Miami, came back here in May, and I have the second tank of gas that I've used, and I think that's pretty typical of a lot of people. The market has come back, but it's really selective. The top 10 NASDAQ stocks represent 44% of the entire value of the NASDAQ, which is 2,700 stocks. So if you have a diversified portfolio, you haven't done as well as the tech stocks had done. If you're in energy, hotels, gaming, hospitality, really bad. Banks are very low. They're still down 30%. Small cap stocks have not recovered. So even though the S&P hit an intraday high yesterday, the average portfolio is even at best, and many portfolios are still negative. Because the small caps are low, you have an opportunity to transfer your closely held business at very discounted rates relative to what they were worth in February. Same business, you're probably doing as well as you did before. In our accounting practice, our clients are doing fairly well. Again, if you're in energy or if you're in hospitality, that's an issue. But other than that, the clients in construction are doing well. The clients that are in other parts of the economy are doing well. And the biggest issue for many of our clients is getting materials because of COVID. Next slide, please. So now I set the stage where we have the ability to take advantage of the volatility in the market. When the market is volatile and the VIX is as high as it is now, it allows you to transfer assets at higher discounts for lack of marketability and for lack of voting control. So that's what we're going to be talking about. Before we get into the insurance and I turn it over to Jimmy, we're going to talk about some estate planning that you can be doing currently that don't involve insurance. Until 2026, you can gift husband and wife $23,160,000. That's a lot of money. And you can leverage that by some of the techniques that we're going to be talking about. So in our practice, we've been successful in transferring large businesses to second and third and fourth generations to take advantage of this high exemption equivalent amount. You can also make gifts of $15,000 per donee to anybody you want per year per person, 30,000 husband and wife, and that exemption comes in handy for life insurance gifts to trust. This example here, which is a busy slide, I apologize, shows gifting $11 million and not gifting it. And we're encouraging our clients, if they are going to make large gifts, do it sooner than later. We have an election coming up, and the Democrats may change this. It may revert to the old law. We're not into scaring clients. We don't think it's going to go below $5 million per person, $10 million, but considerably less than the $23,160,000 that is on the books today. Regardless of whether the Democrats change it or not, it's going back to the old $5 million limit plus inflation in 2026. So we're encouraging our clients to see us now. Don't procrastinate. The stars are aligned to do some significant planning currently. What this slide basically shows that if you have a $100 million estate that grew from 50 million to 100 million, less the exemption, that you're going to save about $6 million, $7 million. The tax due with no gifting is 38 million in this example. If you make an $11 million gift and you get that asset out of your estate and it appreciates, then the tax due is $31 million. We can only do so much with the wealth you've accumulated. You can only give 23 million of it away. And that's where insurance comes into play, particularly if you have illiquid assets. Many of the clients at our firms, whether it's Seubert, Miami Life, or Schneider Downs, have most of their wealth tied up in their closely held businesses. They are not liquid. They are bricks and mortar rich, in stock rich, and that's where the insurance comes in to provide liquidity for legacy gifting and for taxes and to provide working capital for their businesses. Next slide, please. So a simple strategy is to take advantage of these discounts that we're talking about, which can be as high as 50% for lack of marketability and for lack of voting by using non-voting stock, and transfer them now in trust. It can be a generation skipping trust that is set up so future generations are no longer taxed on those assets. And a lot of attorneys use the irrevocable trust. It is irrevocable, but there are lots of strings that you can maintain on those assets, so it shouldn't really interfere with your ability to control what's going on, particularly if you are gifting non-voting stock and maintain control in your closely held businesses. When you gift these devalued assets, we do evaluation for you. We have been in front of the IRS. We've been in court fights with the IRS to substantiate the value, and we will not take a value that we can't fight in court if you get attacked by the IRS. Next slide, please. So what are some of the strategies that we utilize for our high net worth families? I'll be talking about grantor retained annuity trust, sales to trusts, and also intra-family loans. Next slide, we're going to be talking a little bit about grantor annuity trust. And this is a great technique if you've used your $23 million up and you still have a taxable estate. Because what it allows you to do is to make a gift with no value for $1. And in exchange for making the transfer to the trust, you get a payment for a period of years equal to the value we appraise the asset at with discounts plus a very low IRS rate. Now you can see the rates on a midterm rate, which is 3 to 9 years, is less than 1% in April. In May, it was 58 basis points. For September, it's 41 basis points. So basically, you're going to be able to transfer that asset with no estate and gift tax liability, and you will get back the value of it at a discounted value plus 41 basis points if you use a 3 to 9 year term for your annuity. And an annuity is like an installment sale. This is a very good technique to get the asset down one generation. because of technical rules that I'm not going to get into today, you can't use this technique for generation skipping purposes, but you can use it to get it to your kids in your business. And sometimes you don't want to skip multiple generations. So we utilize this technique a lot. I did it for a large client of mine. Actually, it wasn't so large when we did it. And we transferred $1 million, because that's what you could do at the time, to each of the kids. When we sold the business, about 20 years later, each of the kids got $100 million. So it can be a very powerful technique, and we utilize this quite often. Next slide. Now the next slide will show, kind of went over everything on this slide, I think. The 75-20 rate that you use for grats is a little higher than the midterm rate, so I misspoke, but it's still about 1%. Next slide. So here's some savings. The higher the growth rate of the asset after the gift, the bigger the amount you can transfer. So if we take $1 million asset for a 3-year term, you as the parent, the grantor, would get $346,000 a year for 3 installment payments, and the remaining amount at a 10% growth rate would be $183,000 using a 2% rate. Again, the rates have come down. They're actually lower than this slide that I prepared about 2 months ago, and I should have redone it. I apologize. But at a 10% growth rate with a 1.2% interest rate, we can transfer $201,000. And if it grows, and don't forget, we're using a discounted value for the value of the gift. If it grows 20% during that 3-year period, which a lot of our clients do grow at that rate, we're transferring $485,000 to the next generation with no transfer tax consequences. So this can be a very powerful technique for an appreciating business. The question comes up, what happens if the value goes down? If the value goes down, you basically get your stock back and you haven't accomplished anything. Next slide. Now, what if you want to transfer to future generations, or you don't like the grad idea because if you die during the term, you don't really accomplish anything. You have to live the 3 years. So a lot of times we use term insurance to make sure that if it doesn't work, that we have a backup plan. An intentional defective grantor trust, again, the lawyers came up with that. I'm a lawyer, so I take responsibility. What you're doing here is a sale to a trust as opposed to an annuity payment. And why do we call it a defective trust? Because we're taking advantage of loopholes in the tax law that the transfer is exempt from estate tax if the transferor's death, but the transferor, the parent, pays all the income taxes on the transfer to the trust. That is an additional gift to the next generation that escapes estate and gift tax. Very powerful because the kids get all the income, the future generations, but mom and dad are paying all the tax, which can be another 40%. So that's why they call it a defective grantor trust. It's defective from income tax, but it is not defective for estate and gift tax. And it can be for a term of years utilizing the AFR rates, which are 17 basis points for a 3-year loan or less. For 3 to 9 years, it's 41 basis points. And for a long-term over 9-year loan, it's 1.12%, which is basically peanuts. You can have flexible payment terms. You can have no payments for a couple of years. You need to see the trust with 10% equity for this to work. and it is a GST trust, generation skipping, so it can go on for multiple generations. In Florida, where I practice a lot, it's 360 years. Pennsylvania, it's indefinite. So these are very powerful trusts that can skip estate and gift taxation for many years. Generally, they're funded with non-voting stock. Next slide, please. Lots of times clients ask us, the sell to the defective grantor trust, is it a real aggressive estate planning technique? It's moderately aggressive. There are lots of lawyers that utilize it, but it isn't as safe. It is an intra-family loan. What a lot of clients are doing is they're utilizing the loan rates, these low interest rates, and loaning money for their kids to start businesses in doing different things. Remember to follow the formalities and to charge adequate interest. It should look like a real loan. And lots of debt you may have you should look at refinancing it, whether it's intra-family debt or debt to third parties. We go to the next slide, and what I want to talk about is not directly on the slide. We're going to get into some life insurance in a minute. You should look at assets that are in trust now that have depreciated in value. It could be real estate, it could be closely held business, and consider swapping those out for other assets. A properly drafted trust will allow you to do that, and you should evaluate your present estate plan in light of these low interest rates in order to maximize the utilization of trusts that have been funded pre-COVID. Now, you can't utilize all of these techniques that we talked about today, the sale to the defective grantor trust, and intra-family loans to reduce your estate tax to zero if you have a large estate. And that's where life insurance comes into play. And before I turn it over to Jimmy, life insurance now is looked at not just for death replacement for when somebody dies for cash. It's looked at as part of the asset allocation, along with your closely held real estate, your business, and your stock and bond portfolio. So with that, I'm going to turn it over to Jimmy from Miami Life. I just met Jimmy 6 months ago. We have an insurance practice at Schneider Downs that I interface with Seubert on and help them with their life cases. They are an excellent resource, and they have access to all the top tier companies, and they've been absolutely excellent to deal with. Jimmy? Jimmy, are you muted? Jimmy, you're on mute. Is your phone working?
Yeah, can you hear me now?
Yeah, there you go. Okay.
Perfect.
I was worried.
Hey, Jimmy, it looks like you're on mute again.
Okay, can you hear me now?
Now we're good.
Nice. Thank you very much, Dawn, for the kind words. My name's Jimmy Milliron with National Brokerage Atlantic and Miami Life. What our two firms do is we encompass the entire life insurance, disability, fixed annuity ecosystem for distribution and retail. We work on the distribution side. We represent over 40 different carriers. We are product and carrier agnostic, meaning that we are working with our teams with Miami Life on our design team. We're collectively working with financial professionals such as Dawn and Seubert throughout the country, Brandon Mueller and their clients, as in a holistic engagement with their clients to come up with the best solution utilizing life insurance as a tool for either estate planning, wealth transfer, charitable giving, accumulation, distribution, in the form of a replacement of retirement income, utilizing the unique taxable concepts of life insurance, permanent life insurance, of being tax-free growth, tax-free distribution, and a tax-free death benefit. As I mentioned, we work nationwide. We have over 400 different advisors, whether they're RIAs, broker-dealer selling agreements, CPA firms, legal firms like Dawn's, property and casualty. So we see a whole gamut. Our specialty is working with high net worth individual, high net worth clients, ultra high net worth, both foreign and domestic. And what we're seeing in the marketplace with COVID, initially back in March, there was a big rush. And what occurred was a lot of the major companies, they stopped underwriting for 71 and above. They cut it and they postponed these clients. You couldn't get any life insurance for about 2 months. Now it's opening back up. For instance, John Hancock, they're underwriting up to age 90 right now. So they're back to their pre-COVID levels. Now on the consumer side and from our financial professionals, we're seeing a huge influx of life insurance reviews. Number one, I'm putting on the review right here on my slide that we're seeing reviews of policies that were purchased 10, 15, 20, 30 years ago that have been in trust, reviewing the performance of those policies. At times with the performance of those policies, those were linked to different higher interest rates, modeled at higher returns, not funded properly. And now everyone thought that we have this life insurance in place, whether it's in a trust and so forth, but it wasn't funded properly for the past 15 years, and it might end at age 85. So we're doing reviews and replacements currently right now. There's been a huge influx of new life insurance requests for all ages. We're seeing a lot in the 40s and 50s and an overwhelming amount in the mid 60s to early 70s right now. One of our other specialties is premium financing arrangements and utilizing leverage to purchase these large amounts of life insurance. Flip to my next slide here. Leverage accumulation strategies. So we're utilizing these historically low interest rates from transactional lenders or relationship lenders. Transactional lenders such as Wintrust, who specializes in life premium finance, where you do not have to have any assets. US Bank. We have some local banks in the Pittsburgh area, Next Tier Bank, Ameris, and we're funding these large life insurance policies utilizing the bank's money to pay for them and also paying back the bank within the design period of anywhere from 10 to 15 years. And we offer this concept to individuals such as Don, and he works as a wonderful point of sale for us right now in conjunction with his clients and our clients, that financial professionals are kind of orphaned that needed expertise, such as Don on the estate side of the case design, the carrier and product selection, and our in-house underwriting team to make sure we're looking at all avenues to properly underwrite that individual to get them the best rate, carrier, and product, and working with their team of trusted advisors to put these strategies into place. So we have leverage accumulation strategy right now, and just this leverage accumulation strategy is commercial life premium finance. The estate is primarily made up of illiquid assets that do not produce enough income to pay the premium. The cost of borrowing the money, which is in our current situation and for the foreseeable long term, the cost of borrowing the money to pay the premiums is less than the return generated by the asset held in the estate. Financing through that third party, the same way we have a multi-carrier and multi-product platform that we're choosing, we're consulting on the product and carrier. We have a multi-lender platform to help choose the best rate and the terms and so forth, and help reduce those gift tax exposure, working with teams like Dawn. And we're positioning this as that alternative asset for estate retirement and or business planning. And one thing to add is with commercial premium finance, it's very popular with real estate professionals that have a lot of assets. A lot of their assets are tied up in their real estate. They need the protection though, whether it's from a buy-sell, key man, or from estate planning to utilizing life insurance. However, when they see the amount of premium to be paid, it's often a sticker shock. And you have a choice. You can buy a term policy that will cover you just like renting a home or renting an apartment. It'll cover you for a set 10 to 30 years, but it is permanent policies where we're utilizing that cash value, the accumulation of the tax value, tax-free, and that death benefit to cover both now and later. That's more attractive than for most clients utilizing this concept. So we have right here, if we can, let me see if the next one, can you see this, Dawn? Would you like to talk about this case, Dawn? This is familiar with you. I'm having a computer issue right now.
Okay. Premium financing is a way to buy life insurance with a 77% discount and take advantage of the very low IRS and bank interest rates and invest it in a policy that takes advantage of the stock market over long periods of time. In this example, which is an actual case that Jimmy and I worked on for a 62-year-old woman in pretty good health, we start out with a premium payment of $1,730,000, which the client was not interested in paying. What the client is paying instead of that is a bank loan of $275,000 a year for 10 years. So you can see the leverage. The total premium is $17 million, but the client's only paying $2,750,000. We're taking advantage in this case of the low bank interest rates, which start out at 2.5%, and they're increased every year up to 340 basis points or 3.4% in year 10. The beauty of this product, it invests in different stock market indices such as the S&P the NASDAQ, and the EFO, which represents international stocks. But unlike your stock portfolio at home, which you can have negative returns. In '09, some of the returns were more than 50%. In March, they went down almost 43%. In any given year, you can never have less than a zero return because of the use of derivatives by the insurance companies. So you would start over in the next year with no zero return. This policy that we're illustrating here is projected to earn 5.67% a year every year, except for the first year. In the first year, for conservative purposes, we illustrate this case, it's zero interest. So there's no interest being credited the first year, although it's possible that there could be interest credited in appreciation the first year. In the 11th year of the policy, there is enough cash value in the policy to pay off the loan. There's 19 million, there's no columns in this illustration, but if you go over about toward the end, the fourth from the end, there's 19,912,000 of cash that's accumulated in the policy. We're going to take 17,371,000 of that to pay the loan back. So now the policy is owned free and clear, and there are no further premium payments due on the policy, and there's still $3.5 million of cash value in the policy, assuming a crediting rate of 5.67% in years 2 through 10. So the question is, what happens if there isn't that interest rate? There'll be less cash. If you do better than 5.67%, and some of the indexes we use do much better than that on a historic 40-year basis, doesn't mean the next 40 years are going to be good. And let's face it, the market's high right now. You have a situation where the policy needs to be monitored. But over a long period of time, there's a very good likelihood you will achieve the 5.67%. If you don't, you may have less death benefit and less interest. At life expectancy, and life expectancy for a woman is about 87. This generates an internal rate of return of 13.43%. So a lot of clients will say, well, if I get 9%, I'll be happy. So it generates a very high return on the death benefit. In the cash value, you could terminate it at age 75 and just invest the money. You'd have 13 million to invest, and that's an 8.7% return. And this has been around a long time. I've had clients bring me illustrations over the years, and I've never been real excited about the concept until recently. Why am I more interested in it now? Where for the last 3 decades, I was kind of ambivalent at best to it. One is the financial relationships that Miami Life have are best in class in the industry. The relationships with NextTier, with Wintrust and other financial institutions allow them to borrow money non-recourse other than using the insurance as collateral in many cases. In the past, when we've gone to other financial institutions to do premium financing, the client had to sign recourse on the loan, which impacted their ability to borrow in their businesses. And I never like clients to borrow recourse. I always want them to borrow limited or non-recourse. So that's the first reason why this is an opportune time, because our financial people at Schneider Wealth Management think that interest rates are going to be very low for a long time. The second reason is the low interest rates. We have some clients that are doing this and they're borrowing on their stock and investment accounts at 100 basis points at 1%. Now, this illustration you can see works very well at 2.5%. It's funny, this was done 4 or 5 months ago. We just closed this case, and it turned out that the bank rate was about 2.35%, a little lower than what we're showing here. But at 1%, the IRRs are really off the chart because the ability to borrow at low interest rates make this an attractive product. We're not utilizing pie in the sky assumptions. We also will run this at 5%, 4 3/4 to do some sensitivity analysis on the death benefit. Jimmy, you want to go to the next slide?
Yeah, I'd like to also add to this. When this case was positioned with us, Dawn came and they had a choice. Where this 275 number came from was the client wanted to pay $275,000. That was the amount they wanted to pay for life insurance for a 10-pay product. And again, we're product and carrier agnostic. We don't have a team favorite. And we position this as, by utilizing a 10-pay at age 62, that they would have a guaranteed policy to age this female to age 105. What would $275,000 buy that individual? It would purchase them on a universal life, an index universal life product. It would purchase them $10 million level death benefit to age 105. On a whole life product from New York Life and Mass Mutual, it was going to purchase anywhere from 12 to 14 million to age 105. From a universal life standpoint, just a plain old GUL, it was going to purchase roughly about 7 million in death benefit leveled out.
Yeah,
we show them
is a universal life product, but you can see even at age 100, which is the low point, you have a death benefit of 9 million, and a life expectancy of a death benefit of 35 million. This is not for everybody. It's for a client that understands leverage and feels comfortable with leverage. And we monitor these policies every month, and there's an incredible amount of flexibility, as you'll see in the next slide.
So this slide is for income and accumulation. This is for a 39-year-old that was just recently placed. He was a partner in a law firm here in Miami. He did have a need, has a need for a death benefit for his wife. He has one young child. However, his main purpose of this policy was for accumulation and income of what we spoke about before. Tax-free accumulation in the policy, a tax-free distribution from the policy in the form of a loan for income. So what this particular gentleman came up with was he had $75,000 he was going to put into a product and just pay the premium and get a lesser amount of income distribution. One of his particular clients was did a premium finance, and it interested him, and that's why his advisor came to us. So we showed him with leveraging that same $75,000 client payment that goes towards interest and principal, and we can see that the interest rate is slightly higher, and that's due to the size of the the loan borrowed, that's the premium paid by the bank, $326. The client pays $75,000 towards interest and principal. We're putting it with the 5.67. The loan will be paid back year 11. The client day one has $10 million worth of death benefit. In this particular example, he wanted to see, it's modeled that he could take a lump sum out at age 55 of 1.3 million, still have a death benefit of 10. Then at age 70, year 32, he can potentially start taking about $790,000 out in income from the policy, dissipating the death benefit, because this is built for not death benefit, but for accumulation, but it still holds a death benefit. And this is the telling story. The client pays $750,000. The bank paid $3.2 million. The policy paid back the bank in year 11. And we have a tax-free distribution, including that policy payment, of about $29 million.
Let me interject a couple more basic points. When these policies are for estate purposes, they're owned by an irrevocable insurance trust, and the death benefit, it's all benefit of insurance, it's all tax-free accumulation, tax-free distributions from the policy, whether it's a return of capital or whether it's a loan, and the death benefit is triple tax-free. So it's very important. It's also important now with these low interest rates that if you have policies that you buy, you better review them with the Seubert agency, because they're probably were purchased at much higher interest rates, and with even fixed universal life, not stuff that's tied to the stock market. You're going to be shocked that you're going to have to pay more money into those policies. They will not perform as advertised when you purchase them. And this is a big issue right now, because if you bought a policy as recently as 5 or 10 years ago, that policy is not going to go as long as you thought it was. It might not even get you to 5 years within life expectancy. So I would work with your folks at Seubert, get them your policies, and they can review them in conjunction with us. And, you know, I'm not saying to replace them, but you may need to put more money in those policies so they don't fall apart on you when you need them most. And if you take anything away on this insurance part of this webinar, it's that. Because, you know, it's rare that you have a client in their 40s, 50s, and 60s that doesn't have any life insurance. But that's a very important thing that you need to do.
Thank you, Don. Brandon, I think we can wrap up the life insurance portion, because I know it's a terribly exciting topic.
Are there any questions, Brandon? Any questions from anybody?
We have no questions at this point.
Okay, if anybody has a question, send it in and we'll stick around for a minute or two. And if not, we'll wish everybody a great day.
Jimmy, did you want to wrap up on what you're at here in the slide? Jimmy, is there anything you want to say on this slide?
No, this is just, again, the final part of our services, that it's a full, we work with your advisor, whether it's insurance advisor, whether it's Brandon, we all work holistically together to navigate you through a very complex financial tool of life insurance to make sure the appropriate carrier product and premium payment method is there in order for you to have that benefit, or your heirs to have that benefit when it matters the most.
If you guys think of, or women think of any questions after the webinar, feel free to get with Seubert and we can answer questions at any time. A lot of stuff talked about here today, a lot of complex topics, and any of us would be happy to follow up.
So yeah, I agree with what you're saying, Don. You know, this is a high-level strategy. It's sometimes when you're talking about GRATs, it might be an introduction. A GRAT might be an introduction of a new term to some people on the phone. It might not be, but yeah, as this marinates or sinks in and questions arise, please feel free to reach out to us, Jimmy or Don. I mean, all of us on any questions that you might have. As Don and Jimmy were saying, we're more than happy to review the policies that you potentially might have in place, advise, you know, if it's good, bad, and different, and maybe come up with some other options depending on what you might want to achieve. And as any individual or any business evolves as we age, what you originally bought it for or you're looking to buy life insurance for might have changed. So, you know, more than happy to consult and work and figure out the best strategy for you going forward.
Thank you for setting this up, Brandon. I enjoyed it and appreciate you doing this.
Thank you very much, Brandon.
Thank you, guys. Great job.
Thank you.
Thank you.
See you, everybody.
Bye-bye.